This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. The trend-following mindset doesn't exist in a vacuum. There are other mindsets very similar. For example, the venture mindset, the venture capital mindset is very similar. We don't know what's going to happen, so we make bets, we have stop losses. Trend following, venture capital, quite similar. My guest today from Stanford, Ilya Strebulaev, writes a new book, The Venture Mindset: How to Make Smarter Bets and Achieve Extraordinary Growth. I mean, for all you traders out there, that could almost be a trend following title, right? But let's face it, whether it's venture capital or trend following, it's counterintuitive. The idea that you can't predict anything, the idea that you'll make many small bets, and the idea that you're going to have small losses, hopefully small losses. And then you're going to get the 100 bagger. You're going to get the huge move, the massive home run. Is your life designed this way? Can you live this way? Well, when you read about all the guys out there, the ladies out there that make these super fortunes, you only get the super fortunes if you think this way, if you play this way. There's no other way. It is the venture mindset. Without any further delay, let's jump right into my guest today and see if we can learn something. I hope you enjoy. Here's where I want to start. In my world, and I don't know how much you know about my world, but in my world, I'm kind of like an academic, not in academia in a way, or an investigative journalist in the finance space in some way, because I got very curious about something, and it's a good setup for you. I got very curious about something in the 1990s because, okay, I wanted to be in trading and I want to make money trading. You look to Warren Buffett and you see the big names and stuff like that. Lo and behold, I stumbled into this particular strategy that goes by many names, from trend following to managed futures to commodity trading advisor, quant trading, etc. And the most interesting thing about it was that people didn't know what was going to happen. Since they didn't know what was going to happen, they had to take many small bets on markets that were starting to show momentum. When those markets started to show momentum, they would take positions, but they didn't know if anything was going to happen. Ultimately, it ends up with this 40% winners, 60% losers, and your winners are much bigger than your losers. Gosh, does this sound connected to your world? I've been telling people for years, when I lose them where they don't understand this trading strategy, I say it's kind of like venture capital.
Whenever you mention winners and losers, it does sound like venture capital. The difference in venture capital, though, is that we don't have 40% winners. We have just maybe 5% winners, sometimes even fewer than 5%, and then 90% losers. I'm an academic in the academia. I'm doing quite a bit of research. In doing this research on venture capital, we assembled the data on effectively every single venture fund and every single venture capital-backed startup in the United States over the last 40 plus years. Lo and behold, more than 80% of early stage startups fail. That is a very different from traditional trading strategies, I think, in the real financial world. And that's why, if you can summarize in terms of winners and losers, how venture capitalists think about their strategy, you can say, using baseball analogy, home runs matter, strikeouts don't. And that's because 95%, 90%, 85% may fail, and then you lose everything, or almost everything. Those are strikeouts. For your home runs, the win could be astonishing. Sequoia Capital invested very little amount of money in Dropbox back in 2007, 2008. When Dropbox went public, they owned a very non-trivial fraction of Dropbox. Their return was well more than 250x. That is an example of a home run. And I think the way VCs think about a home run is very interesting. And I'm curious about how you would approach it in the financial strategy space. The way VCs think about it is, if I'm going to make an investment in this deal, if it is a home run, will it return my entire fund? And then if they think so, then they will invest. Otherwise, likely they will not invest.
It's very similar. You'll have a touch more winners here in the quant trading space, the trend following space. So it's not as much all or nothing. But, as you describe that in your world, what gets me thinking is everyone hears about venture capital. They hear all the stories and cursory stuff in a magazine article, Business Week, whatever, Bloomberg. I would venture to guess. Okay, of course, in your world, you're a professor who's been in this space for a very long time, considered one of the foremost experts. But I think the vast majority of people don't realize how many unknowns there are in trying to be involved in the next Amazon or the next Dropbox, NVIDIA. There are so many unknowns. And I think a lot of people get caught up in the idea that there are these brilliant people that just knew that NVIDIA was going to be it. They just knew that Dropbox was going to be it. But that's not the way it works.
You're so right. Here's a myth about how venture capital and how Silicon Valley works. A genius founder writes something on a napkin, passes that napkin to a venture capitalist. The venture capitalist gets extremely excited, immediately gives a check to the founder. A couple of days later, this company is great, everybody's happy. That is not how it works. First, it's not just about unknowns, but I would say it's about unknown unknowns.
The Robert McNamara world.
Exactly. So sometimes venture capitalists even do not know what kind of questions they should be asking because the market is so new. Right now, we're in the generative AI world, and the market is so new. Sometimes the business model is unclear. The market size is unclear. In fact, the identity of the future market is unclear. But what is really interesting is that venture capitalists seek themselves as risk reduction engineers, which is they know that they're going to face a lot of unknowns. And even if they spend thousands of hours on due diligence, they will not be able to reduce all that uncertainty. They will not be able to uncover all those unknowns. What they're trying to do is to understand what kind of risks they can take on, they can live with, and what kind of risks they really need to be able to uncover before they make that jump and invest into the deal. So I think risk reduction engineers is a very helpful depiction of venture capitalists and how they see themselves. And yes, there are napkins in Silicon Valley, but I think it takes not days and even not weeks, but sometimes months for the venture capitalists to think through all the implications of a particular startup. Give you an example. I just had a student who raised about $7-8 million for a biotech startup. He's been dancing with the venture capitalists that have eventually put money in for more than a year. So that's been a long dance, a long courting, so to say. In my 20 years at Stanford, founded and I'm a director of the Venture Capital Initiative at the Stanford Graduate School of Business, I taught over 3,000 students. And hundreds of students that graduated from my venture capital class became the founders of venture capital-backed companies. It's very rare where venture capitalists invest right away. There's always some courting period, some due diligence period. Now, sometimes the market is so new, so uncertain, and the amount of money is relatively small, then they can plunge right away. But I would say they would typically still spend time on trying to find out as much as possible about the founder or the founding team, because that is going to be in many early stage startups the biggest unknown. Here's a quiz for you. If you think about all the failure factors, startups can fail for so many reasons. What would be the most frequent reason, the most important reason behind startup failure? Most people get it wrong. Most people say, well, startups run out of money, or startups can't find how to go to market.
I would guess the tenacity of the leader.
You're very close. The tenacity of the leader, charisma of the leader. The factor number one is that most startups have more than one team member. They have not a founder, but co-founders. And the number one reason is the infighting between the co-founders, a bad fit between the founding team. The venture capitalists know this, and therefore they spend enormous amount of time trying to understand how the co-founders work together. They do try to understand the tenacity, the resilience, the charisma, the passion of the founder. Amazingly enough, industry expertise does matter, but it often matters less than tenacity and resilience and other stuff that I mentioned.
Let me bring something up, though, that you brought up. So you brought up the notion of due diligence. Then we're talking about very high failure rates. For me, I'm looking at, okay, due diligence, very high failure rates. Are there some VCs, and as you said a second ago, look, if the investment's small enough, then just do it. Don't worry about it. The courting period, I understand logically what you're saying. When I think about that failure rate, in some ways, does it matter? When the failure rate's that high, you can do all the courting in the world, but you already know you're going into this as a venture capital making an investment in an early stage company. You already know you're going into this with odds that are way against you. So it seems like you could do all the courting and everything, but you're still going to fail on so many.
Yeah, it's interesting. There are 2 points here that lead to due diligence. The first one is because the failure rate is very high, but it's all about home runs. If our due diligence can increase the chance of a home run just by a little bit, then we really would want to exert a lot of effort. In fact, my research shows that on average, venture capitalists spend more than 115 hours on each startup that they end up investing in. That's a lot of time if you think about this. That is because they would like to avoid investing in startups that definitely are not going to make it, definitely not going to become home runs. And they would like to uncover those diamonds in the rough that have a little bit higher chance of becoming fantastically successful. Now, there is the second reason, which I think is very important, and I'm curious how this relates to the world of quant trading. Venture capitalists value flexibility over commitment. What do I mean by that?
They have a stop loss.
They have a stop loss, or as we call it in our forthcoming book, The Venture Mindset, double down or quit. If you look at the most successful venture-backed companies, say unicorns, those companies that achieved at least reported valuation of more than $1 billion. Those unicorns raise on average 6.5 rounds of venture funding. So in fact, they constantly go back for more money. Every single time, venture capitalists have to make a decision. They have to make a decision, are we going to double down, so invest more? Are we going to hold, or we're going to fold? In fact, this is a very interesting fact. Venture capitalists, as I've discovered, are very close statistically to poker players. Professional poker players differ from amateur poker players because professional poker players quit, fold much more frequently. As you said, they know what stop loss is. The same with venture capitalists. The best venture capitalists are much more likely, in fact, to fold. But then when they double down, they really double down. Coming back to due diligence, in many ways and often, the real due diligence starts after we make our very first investment. Go in with a very small check. Sometimes we might invest in the pre-seed round. Sometimes we just might get information rights so that we can observe what's happening with the startup. We have an option then, if we really like the startup, to lead the round in the future. Every single time, we will be able to either just say, sorry, we're not going to invest again, or we'll say, this is amazing. Like Sequoia did, let's say, with Airbnb, investing again and again and again in the same company, every single time doubling down, because the company was growing very, very fast. It was clear that it was a home run. Venture capitalists, therefore, said, well, we would double down, but at the same time, they would be saying no to other startups.
To give you a comp or a contrast, also to your poker point, I did a documentary film years ago, and I brought in many poker players, well-known ones, to talk on tape about this issue, and I've had many poker players on this podcast. But the double down point is interesting because from a quant perspective, you're taking these positions, no fundamentals, just momentum. And if something starts to roll your way, the typical strategy will be to lever up. Even if you don't know why something is taking off, you don't have any real fundamental view on it, you'll lever up and ride it as long as you are. It goes back to the David Ricardo line, ride your winners, cut your losses, back to the 1700s. It's that concept, which is very similar to venture capital as well, too. But the double down part, it manifests itself in a different way, but it's the same principle.
Yeah, I think momentum is really important in the venture capital world as well. Again, going back to Sequoia Capital, they accumulated the stake of more than $10 billion in Airbnb over 10 years. I think one of the differences maybe between venture capital and quant trading is that it evolves, uncovers itself over years, not minutes or days.
Just to clarify, though, in the quant trading that I'm talking about, these are positions that often might go on for well over a year. I'm way away from the minute by minute stuff.
Right. Well over a year is great. The average unicorn takes 8 to 9 years to mature, to exit, so to provide returns for investors. It's a long game. You have to be really patient, really, really patient. In some cases, for example, let's say WhatsApp investment, that materialized quite fast. More often than not, it's 6, 7, 8, 9 rounds, and each round is happening every year or every 15 months. Therefore, it's a very long game. I think there's something else which is very similar between quant trading and venture capitalists. This is the part of the venture mindset because venture capitalists face the following conundrum. They have a very high failure rate. They need to decide whether to double down or quit. But also, they really get sometimes psychologically attached to the startups that they invest in because they know the founders personally. They deal with the management all the time. They're often board members. They're exposed to what we know, what we call as escalation of commitment. Throwing good money after bad ones, I think, is a very important problem for venture capitalists. They came up with a number of solutions over the years to deal with this escalation of commitment problem.
In behavioral finance, behavioral economics, for example, Daniel Kahneman, I would say that Daniel Kahneman's work is the underpinning of successful quant trading because you've got to have that mindset. I've had so many people on this podcast that'll talk about trading psychology. Your word in your book, mindset. Mindset is as important as the money. It is as important as the technique. If the mindset's not there, you're toast.
Right. It's interesting you mentioned psychology, Michael, because what venture capitalists, I think, found, this is a part of the venture mindset, is that psychology can be very powerful. The solution to, let's say, the escalation of commitment problem is not trying to change your psychology, but to change your decision-making process. And here are a couple of examples. One, do you know that when in the venture capital world, you write your first check into a startup, very often a partner of the venture capital firm can do it on their own. They don't really need to ask anybody else. There's no investment committee. When they decide to double down, then they need to go back to their partnership, ask for permission to invest again. That is a protection against the escalation of commitment. Here is another example, which I think is really very powerful. Some VC firms say, we will not invest again in the same startup unless we can find another venture investor, reputable venture investor, that did not invest in this startup before, that is willing to invest, or that is willing to lead the next round.
Spread the risk.
It's not really just spread the risk, Michael. It is try to find an independent signal of quality. Because you're the founder, Michael, and I'm your board member, venture capitalist, and I just invested $5 million. A year later, your company is not doing that great. And I go back to my partnership and say, Michael missed some milestones, but I think really, because remember, there are a lot of unknowns. You still can be a home run. And I'll say to my partners, you know what? I think Michael's startup needs 12 million more, and that really will help him. And in many partnerships, my partners will tell me, well, okay, we can invest, but only if you find somebody else. If you find somebody else who, at arm's length, who never invested in Michael before, who will agree to lead the round. And I think that I observe a number of successful VC firms who follow this strategy quite successfully. And again, you see, they try to deal with psychology by the TV game, Who Wants to Be a Millionaire? What do you do in that game? Well, you can ask the audience, or you can call a friend. This is what, in fact, venture capitalists do. They call a friend, which is another venture capitalist. There's the audience, which is their partners. And they use a lot of other tricks that prevent them from going down this rabbit hole of throwing bad money at it, because this is very easy to do in the venture capital world. Very easy to do. I work a lot with large organizations, large corporations on, for example, how they deal with large innovation projects. And I can clearly see often that decision makers in large companies or in government organizations or in the army, they really can learn from how venture capitalists deal with dynamic decisions, where they have to make a decision on the same project again and again.
Can I take you back in time? I'm curious. For me, I can remember when it was. It was in the early 90s when I first had this light bulb moment of, wow, there's this interesting, for me, under the radar, and I still think till this day, this under the radar strategy. Of course, venture capital is not under the radar, but I'm curious for you, when did you first, I mean, you've been in academia for a while, you're a well-studied guy, been around the world, but when did you first have your aha moment? How far back does it go when you understood how venture capital works? Because it's still a fascinating thing, because I think, again, the average person, that could be just doctors, attorneys, whatever, people not connected to my world or your world, they just think Warren Buffett's just a brilliant guy and he made perfect picks and that was his whatever. And okay, maybe it was for Warren Buffett, but that's generally not how it works in finding great investments. So when was that moment for you when you first understood this venture capital mindset?
First, I didn't have one bulb moment when I realized that, oh, wow, that is very different. The start of this realization came when I arrived to Stanford and I started teaching our students at the business school. And many of those students wanted to become either founders or venture capitalists. And I arrived as a newly baked professor of finance.
You're coming from Russia at that time. So what age would you have been about?
I did not come from Russia. I was born in Russia, but in fact, I came from London. So I had spent many, many years in London.
That bio of yours is a little bit unclear out there. You'll have to punch them a little bit because I was reading it wrong.
To tell the truth, I had never heard of venture capital when I was in London doing my PhD in finance. And do you know why? Because there were no academic research, effectively, on venture capital. Because venture capital is kind of a secretive industry where there was very little data, very little was known about venture capital. Frankly, people do not think it was important. I don't remember hearing even once about VC when I was in London. Then I came to Stanford in 2004, and I started teaching not venture capital, but finance to our Stanford MBA students. And many of those MBA students, being in the center of Silicon Valley, wanted to become either venture capitalists or founders. What I realized talking to them is that, well, venture capitalists don't think like a lot of other finance professionals. I was intrigued. Initially, there was a lot of counterintuitive thoughts because a lot of things that venture capitalists do or how they behave seems inconsistent with the principles of finance that you can read in any MBA textbook or that you teach to our MBA students Finance 101. At some point, it just dawned on me, wow, they're doing this not because they're smarter, not because they're different species, but because they really historically have been facing a very different environment. Something that we already discussed. Many rounds of funding, unknown unknowns, home runs, and so on. And as a result of that, they had to come up with very different principles of how they make decisions. I think over time I realized that in most cases, each individual home run, I think, has a lot of luck in it. The luck component is large. But over time, there is virtually not much luck because it's all down to a process of how you make decisions.
They figure out an expectation. They know mathematically what they're expecting.
That is right, but they approach these expectations in a surprising, counterintuitive way. That would lead me to switch careers now within the academia. But I switched careers. I started concentrating more and more on studying venture capitalists as opposed to just finance people. For the last 10 years, I've been doing nothing else, more than 10 years now. That allowed me to go into venture capital firms, to observe them, and to finally collect very high quality data, which allows me to pronounce some stuff about venture capitalism because there are some justifications for this.
I'll share with you back, most of the traders in my world, they don't see eye to eye with the efficient market hypothesis. Got this Benoit Mandelbrot view, which is like, hey, this efficient market thing works great until the next black swan swims in. Your story is so interesting to me. It reminds me of just me digging through. And I remember coming across these traders in the 90s, and I was seeing all these performance track records. It was fascinating because all these individuals were not connected. They've been around for decades already. They were producing this performance, and often the performance would be similar. These disconnected traders might make 10% in March and then lose 5% in April. Not all roughly the same, but generally the performance track records were correlated. And this was so fascinating. I was like, why is no one paying attention to these track records? There's something here. That was what led me down the rabbit trail, so to speak, was just this curiosity, which I hear in you as well, which is you were just curious, like, why is this not being covered? Why has no one done the work here?
Absolutely. I think curiosity really has driven me to where I am now. My curiosity peaked exactly because the way venture capitalists made decisions seemed initially kind of crazy to me.
Because of your training, though, it doesn't seem crazy to you now.
No, it doesn't. I think it doesn't seem crazy, not just because of training, but because of the principles that I've discovered.
You said it appeared crazy to you. And I said because of your training, I meant going through school and whatnot. Why would the initial understanding of the venture capital way, the venture capital mindset, why would that have seemed crazy to you when you were not indoctrinated at that time?
Some of the stuff seemed crazy. Let me give you an example. On average, to make one investment, venture capitalists consider 100 opportunities. So in fact, they do some kind of due diligence on 100 opportunities and invest only in 1%. Coming from normal, I would say traditional PhD in finance training, 1 out of 100 did not seem reasonable to me. That seems to me there's too much effort, 99% of effort wasted. Can't you do it more efficiently? Can't you come up with a way so that you invest in more opportunities, or you spend less time, less efforts on those opportunities you actually will not end up investing? That's one example where it seemed strange, at least, if not absolutely crazy. But there is a method to this craziness, Michael, as I've discovered. It all goes back to home runs, meaning that to find a home run, we in fact need to consider a lot of opportunities. In fact, the best VC firms consider way more than 100 to 1 for each one that they invest in. But here's the challenge. When you end up with hundreds of opportunities, how do you do this more efficiently? What I did not realize at the time, Michael, what I do realize now, is that venture capitalists use a very different process at the top of their funnel, where they face hundreds of opportunities, and at the bottom of their funnel, where they face a few remaining opportunities. At the top of the funnel, they ask a very specific question, and I call this fast lane, the fast lane approach. They ask a question: why should I not invest in this startup?
Let's pretend you're a venture capitalist and I'm the founder. That'd be one of those questions you'd be asking me.
I will be asking this question myself. You're obviously pitching me, okay? And the very first question that comes to my mind, okay, why will I not invest? Why should I not invest in Michael? So what are the red flags? Maybe Michael seems untrustworthy. Maybe Michael doesn't seem resilient enough. Maybe even in the best case scenario where Michael is going to check all the marks, the market is very small. I will never be able to return my fund. The moment I see one critical flaw, one critical red flag, I move on, Michael. Okay, I say, nice meeting you, bye-bye. Or I will not respond to your call. If you pass the first filter, if you pass the fast lane, then suddenly I'm going to switch to a slow lane. Then I'm going to ask the question, why am I anxious? Invest in Michael. But that is going to be asked only for 10, 5 opportunities per one. One of my VC friends loves telling our venture capital class at Stanford, why am I greedy to invest in Michael? Do you see the difference? I mean, going back to Kahneman, adding not in the first question, why should I not invest? In fact, changes the entire perspective. And that is what I discovered. Unless you are really love the word you used, indoctrinated, unless you're indoctrinated into this, unless you understand the principles, it kind of sounds bizarre, but now it doesn't. In fact, I think the venture mindset just discovered the way to deal effectively with opportunities where there's too much uncertainty, where there are a lot of unknown unknowns, and where you're going to discover the truth bit by bit. And I think from this point of view, it's kind of similar to quant strategies because you said it's over the year, so it's a long period. And obviously, as you follow your strategy, you discover the truth, so to say, over time. So it's becoming better and better known. And you need to retain your flexibility. And that is exactly what I think the venture mindset is about.
We haven't said it in this conversation yet. People should realize that the conversation we're having is not necessarily if you want to be a venture capitalist or you want to be a founder or you want to be a quant trader. That's not the point. It's the mindset. And the mindset is applicable to all of us as we think about our lives, managing our lives, going through our lives. This type of thinking, I mean, you don't have to go in 100%, but to understand this type of thinking and be able to be aware of it, at least at a minimum, and perhaps apply some of it, is gold for everybody.
Absolutely. Let me give you an example where the venture mindset taught me. Here's an example where all of us can use the venture mindset. Again, the venture mindset is say no 100 times. Do you know that the same applies in so many other walks of life? Pulitzer Prize. Do you know that Pulitzer Prize every year, judges read about 300 books. Every judge reads 300 books and nominates 3. It's also 100 to 1. When I looked up the statistics, I was, oh, wow, the Pulitzer Prize judges are like venture capitalists. If you look at, let's say, Google hiring, Google hires also about 1% of people that apply. Or if you look at statistics at how many houses people look at before they contact the broker using Zillow statistics, it's also 100 to 1 or maybe a bit less. One thing about the venture mindset taught me, I think we should retain flexibility. We should learn how to say no, even to opportunities that sound potentially attractive. But that is because we have not seen enough opportunities. And I think that really could be used as young people think about where to study, or what kind of major to choose, or what kind of job to take. Because many people, I think, take a job too quickly and maybe end up not in the best place.
You have to experiment.
You have to experiment, and you need to have this ability to say no, even to opportunities that might seem initially quite attractive. So I'm using this venture mindset principle, quite often, all the time. I know it's maybe a funny example, but I think it's quite useful. When I choose a restaurant where to go with my family, I'm using the venture mindset. I think I now review more restaurant options than I did 10 years ago before I kind of finalize one that I would like to explore.
It's interesting you bring that up. I have said to myself in the last handful of years, if I know, and I'm in a big city now, but if I know I'm in a big city and I know there's a lot of quality choices and a place is popular, I'm almost willing to trust somebody else to pick food for me. In a way, it's kind of like, don't get so rigid that I can't experiment, because the experimentation gives you perhaps some magic that you never expected. If we all get so rigid that we don't keep trying, you got to take action even if you don't know what the damn reward's going to be. You have to try.
Absolutely. I think the venture mindset is all about experimenting, trying, but also knowing when to stop. Because, Michael, of course, you do not want to procrastinate an experiment for your entire life. So it's both about the power of flexibility and the power of experimentation and the power of saying no. At the same time is the power of quitting and the power of saying, well, now we have to make a final decision.
A guest that I've had on this show many times, quite well-known trader named Larry Hite, quite successful quant trader. He had the first in the quant space back in the, I think it was the 80s, early 90s, first $1 billion fund. And Larry has come on here. He's in his 80s now. He's a really interesting guy. And he will always discuss his dating math that he learned from a friend back in New York City in the day. His name was Larry, but his friend's name was Harry. You already start laughing. But Harry would basically walk up to 10 beautiful ladies in New York City that he didn't know and just say, hey, can I take you to coffee? 9 out of 10 would say, get lost, get out of here. But 1 out of 10 would say yes. And when he got 10 of those ones to say yes, he might end up having a girlfriend. Actually, a lot of young men understand this strategy today. Now, whether or not people like it necessarily, it's very similar, which is meaning you just don't know what's going to happen. You got to try, and you're going to take losses, whether it's in venture capital or love.
This reminds me of something else. When you mentioned that you approach 10 ladies that you don't know, I think one of the principles of the venture mindset is get outside the four walls.
Yeah, yeah.
You can't find a venture capitalist in their offices. You're much more likely to find them on the plane or in a coffee shop because they would like to experiment. They would like to meet different people. Here's a very interesting fact, Michael. I studied the LinkedIn connections of venture capitalists, and I compared them to the LinkedIn connections of, let's say, senior corporate executives. And venture capitalists have way more LinkedIn connections than corporate executives. That perhaps not that surprising. But what I also found out is that the LinkedIn connections of corporate executives are very narrow. They're connected to their coworkers, they're connected to the people they studied with, and maybe they're connected, in fact, to people who work for their competitors because they see them at various industry events. But if you look at the venture capitalist LinkedIn connections, they're very, very diverse because they are trying to diversify. They're trying to find these new great ideas, and they're experimenting, and they're experimenting also with people. So here is what I'm doing now. When I travel, and I travel quite a bit these days, I have my venture mindset goal. Every single time I am queuing at the ticket counter in the airport or sitting in the plane, my goal is just to talk to people whom I don't know. My neighbor, a person in front of me in the line. I actually struck a very interesting conversation recently in London, waiting for a passport in the passport control line. Frankly, Michael, being an academic, I'm not really sure, maybe you've been doing this all your life. Being an academic, I never thought about this. I never did it before. Before I became venture-minded, I never talked to anybody on the plane unless I knew that person beforehand. And now I struck so many interesting conversations, and you never know where it will lead to.
This also goes for accepting or bringing on podcast guests. And for me, I know enough, and I've done this for long enough and seen enough different books and enough interesting guests. I only had to see the title of your book to know I wanted to talk to you. I saw where you worked, what you did. I was like, I just saw the title. I was like, okay, I already know, even if I did no preparation, I already knew I could probably talk to you for hours because of where you were, what was embedded in the title. It was just so clear. By the way, you mentioned the LinkedIn followers. I can also add that I think you might have made a comment about this. Go look at the number of followers. You might have already done this, but the number of followers that people that Mark Andreessen follows on X. It's huge. He follows so many people.
Venture capitalists follow a lot of people everywhere. Sometimes they follow some people whom you would think that famous, successful, rich people would not follow. Every single time they're trying to identify something new, they're trying to discover something before everybody else discovers this. And again, that is the point about the venture mindset. I have to really make a point about the book's title, Michael, once you mentioned it. Here's my big, ambitious goal about the book, and that's why we titled it this way. My dream is to launch the venture mindset movement, because I think that not just in our professional life, but also in our personal life, when we become a bit more venture-minded, I think we'll become more successful and happier as well. Our life is going to be much more interesting.
You don't worry about certain things once you adopt this kind of mindset. You stop worrying about stuff that you can't control.
That's right. It's really interesting. I've been meeting a lot with people from other cultures. In some cultures, people are much more fascinated by the venture mindset just because they never thought that it is possible to think about things such as failure or experimentation this way. I talk to a lot of Japanese or French, where if you fail, typically kind of your life is over. Well, what the venture mindset tells you, no, it's not over. In fact, serial founders that failed in the past are more likely to be successful than serial founders that were successful in the past.
Let me add something to that. Being in Asia right now, I will warn the world on this. And my Asian friends will say, oh, you're just being a homer, you're being too nice. Listen, if Asia fully adopts the venture mindset and is a little less shy, the rest of the world is done. Asia economically, if they adopt this mindset, and you were talking about being in the airport and stuff, I find in Asia, if I do that, people love it. Even shy people, they just love the idea. You might strike up a conversation. They're so excited that you will reach out and do that because it's so abnormal in Asia to do that. The funny thing is I have many Asian friends, and I have one particular girlfriend I can think of where if I do something like this in public, she gets mad at me. She's like, no, you can't do that. You can't do that. I know she's wrong, actually. I mean, culturally, I get that there are some things you've got to balance, all that kind of stuff. But generally, if you do it in a nice sort of way, in a place like Asia, and that could be any country, Japan, China, Vietnam, Thailand, whatever, people just light up. They love it. You say so many things today that resonate with me. So it's great stuff.
Michael, this reminds me of a story. About 12 years ago, I had an MBA student at Stanford from Japan. He was excited by the stuff we talked about that I taught him. He decided to become a founder of a startup, but he also wanted to go back to Japan. He came to my office one day and told me, Professor, I'm going to become a startup founder. Here's my idea. So we talked about the idea. And then he said, but I'm going to Japan next month. I'm going to start up there. And I said, well, good luck. And then he told me, Professor, I want to tell you that you will be the only one who would know about it. And I asked him, what do you mean? And he said, well, my family, my parents expect me to go back to a large company, Toyota, etc. That is what, in their minds, in Japan means success. I will not tell them that I am going to become a startup founder because they think that I failed. And in fact, and I don't remember now whether he had a fiance or a girlfriend at the time, he told me, I'm actually, I think, going to hide this from my girlfriend. And I think that tells you more about the Japanese culture than all the thousands of books that you can read about Japan.
On top of that, though, then they do have this immense success. So it's just different.
It is different, as you correctly pointed out, if and when they acquire the venture mindset. Japan and other Asian countries are going to be fascinatingly more successful. By the way, here's a story about my book. I have this amazing agent, Chris. We sold our rights in the United States very fast. A number of other publishers in other countries, without really seeing the book, bought the rights. In which languages, Michael? In Korean, in Mandarin. But so far, the book is going to come out in more than 100 countries now very soon. But so far, we have not yet sold German, French, or Italian language rights. Europe is less interested in the venture mindset, at least if you judge by the European publishers.
Let me give you the parallel life over here in Vietnam. So I'm the author of 8 books on this quant trading. So I've been at this. My first book came out in 2004. It's now a race. It used to not be a race. Japan would always publish my stuff first. Now Korea is starting to publish first. So it's either Japan or Korea is first every time. And you're right. Europe, French and German, they lag behind. I don't understand it at all. I mean, my book's been published there. It's completely lagging. So every new book that I come out, Japan and Korea, boom, boom. And now even Vietnam, my books are in Vietnamese. This part of the world is eager. They're not messing around. They're not like, oh, I don't think that stuff is important. They're like, oh, hold on. This quant trading, venture capital, we need to know this. And there's no messing around.
Absolutely. This is what I'm discovering. So it's interesting, Michael. To me, it was a surprise. But that also suggests to me that Asia is becoming or wants to become more venture-minded. I believe that Europe, but also America, really have to pay attention to this.
Look, in Vietnam, I mean, I remember when I first came here, the amount of commerce you see, and commerce here could just be somebody that says they want to open up a storefront cafe or coffee or noodles or something. Everyone that I've known in Vietnam over the last decade, everybody wants to start a business. And the venture scene here, and I know from friends, I'm not necessarily in it myself, and I know some venture capitalists here, people get it. Since I've been here watching, I mean, the first Vietnamese billionaire was a lady who started at a low-cost airline. You just see that. Just sharing about Vietnam, it applies all across so many countries. We haven't talked about India. I mean, India is rocking and rolling. I mean, my gosh, a handful of years ago, I would get no feedback from India. And now it's like, my gosh, India is just on fire. India is ready to go too.
Absolutely. I have many students from India. Some of my most successful students who became founders of venture-backed startups are from India. And many of them go back to India these days as well, or becoming venture capitalists, fund managers in India. India is on a rock and roll, absolutely.
I'm not trying to be a homer or praise only parts of Asia, India. I mean, people consider India, Asia as well. Culturally, it seems less chaotic in a way, where it's where people are a little more grounded, in my humble opinion, where it's like, okay, I want to do family, I want to do business. And a little more serious maybe at younger ages is something that I observe. Whereas I think maybe because of American success, younger kids are like, yeah, I'm just going to party in my 20s. And a lot of young kids across Asia, India, they're not partying in their 20s. They're ready to go take it on.
They're ready to take it on, and I think they're ready to experiment as well. That is, I think, a critical part.
I could keep you for hours when you talk about all kinds of stuff. I mean, I want people to check out the book, The Venture Mindset, How to Make Smarter Bets and Achieve Extraordinary Growth. Is this your first book?
That is my first non-academic book. Our goal was to write it in a very, very, very non-academic style. People who read it, my friends, those who endorsed the book, told me that, well, I didn't know, Ilya, that you can write a book that is difficult to put down, because obviously that's different from academic articles. But that was the goal, because I care about the impact. I really would love to launch this venture mindset movement.
I've had so many academics on this podcast over the last decade, and I try to put myself in those shoes, even though I'm not. I feel like I've had this opportunity to introduce an academic topic in a way that's accessible because I never had the quote academic training. I mean, I got my MBA and all that kind of stuff. I never really was in the academic writing way. So I just wrote from like, oh, I'm curious. Oh, this is interesting to me. What do you think about this data? What do you think about this performance? What do you think about the idea of black swans in trading? All this kind of stuff. And I just threw it into the hot pot, so to speak. And that was how I got started with my first book, was just being curious and trying to make things accessible. I didn't know any different. I relate to you saying that. I think it's terribly important. All of a sudden, you're going to find, I would bet, a lot of people that are not in academia and a lot of people that are really interesting are going to be in your world that you never expected to be in your world once you've expanded beyond, quote, academic writing.
Absolutely. And I think writing this book was one of the best things that happened to me in my life, because it allowed me to meet so many fascinating people that otherwise I would not have met. Just by writing this book, I became more venture-minded.
Great experience. Again, the book, The Venture Mindset, How to Make Smarter Bets and Achieve Extraordinary Growth. They can find the book on Amazon. Where's the best place to find you if they want to find you, or if you want them to find you? Where should they go?
Well, obviously buying a book on Amazon or any of your favorite retailer. If you're really interested also in my research on venture capital, research insights, I post 4 to 5 times a week on LinkedIn. That is really an additional stuff to reading my book, to see venture mindset in practice every single day. And what I do there, I'm trying to translate academic research into something that is practicable. And the way I started this is because I wanted to keep connection with my students. It used to be that students took my class and then I loved them. Hopefully they liked me, but then we'll say goodbye to each other and I wouldn't see them again. And I wanted to stay connected with them. And many of them reached out to me and said, Professor, can you share what you're doing now? That's how I started posting stuff on LinkedIn. I would take my academic research on venture capital and unicorns, on how corporate innovators work, angel investors, on startups, why there's a difference between Japan, France, and the United States when it comes to venture capital. And then I started translating this into something that everybody can read, think about this. There's a lot of provocative stuff there, I think. And I started putting this on LinkedIn. Please visit and have a look if you're interested.
You know, I have one last thought I want to share with you, something you just said about contrasting Japan, America, and France. And I sometimes tell my friends in Asia, I say, for all of America's faults, for all of its things that look messy, the thing that America has that is a real value is this cowboy attitude. This cowboy attitude, which is embedded in venture capital in many ways. Maybe it's hard for people to understand. This cowboy attitude is America's secret sauce. If America ever loses the cowboy attitude, America's in trouble.
That's a very interesting comparison, because I do think that many venture capitalists and many founders are cowboys.
For sure.
Indeed.
Yeah. Ilya, great stuff. Please keep me posted. I would love further conversations in the years to come.
Thank you, Michael.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.